Hello, everyone, and welcome to a new session from our Tamkin program, Tamkin International Talks. We are pleased to welcome today Dr. Brendan Price, who will be presenting on the topic Business Modeling and Financial Planning for Entrepreneurs. Dr. Price is an international professor of engineering and business, and he do a lot of things. I will let him present himself, and thank you for being here with us, Dr. Price. It's a real pleasure to host you today.
Well, thank you very much, Zinab. I'll just begin right away then, and thank you all who are attending. Just a very brief description of myself. I actually have two careers. I started off life as a physicist and actually was a scientist for many years. And I was at universities, two universities, in one in Miami and one in Guadalajara, and I was involved in scientific institutes. But I've been involved in my career in biotechnology. I've been very lucky to have co-founded 7 different companies, and I've been CEO of 6 life science companies. This is over a 40-year period. Along the way, I've won a few awards, and at the current time, I am either on the board or advisor. Actually, that's now 7 companies. I've added one in Taiwan and one in Czech Republic. And I I work with the folks at Tamkin as well. And I've lectured in many places all around the world. Right now, I'm involved with 4 startup companies, all technically oriented. One in Nairobi, a really interesting fintech company. And as noted by Zineb, I actually am a professor as well. I teach a course. This lecture is part of one of the lectures from the course. And I teach this in full here in Guadalajara, where I live at Pan American University, and also in Virginia at Virginia Commonwealth. So what we're going to talk about today is the only equation you ever need to know as an entrepreneur. We'll talk about some basic concepts of business planning and business modeling and distinguish that from financial planning, as is in the title. Why do you develop a financial plan? And we'll talk a little bit about a couple of the key financial projections. And then we'll talk about where do you get money? And then if this little yin yang appears anywhere, I have to stop and tell a story. But when I teach entrepreneurship, this is my definition of an entrepreneur: is thinking, planning, and executing from the perspective of a CEO or the entrepreneur, right? And here's the only equation you need to worry about: how much money you're bringing in, how much are you spending, and if the former is greater than the latter, you have a profit. Obviously, if you're bringing revenue, you have sales, you have a marketing force, you may have customer service. If you have expensive, you have some form of operations. You certainly have accounting and administration, and maybe even you have manufacturing going on. And most people think about this as the entire equation. But it's actually, as if you're the entrepreneur or the CEO, you have other things you need to worry about. You need to worry about financing the operation. You need to worry about raising money, raising capital. You need to worry about budgeting. You need to worry about planning. And above and beyond these kind of stay up late at night, work in your office kind of things, you're going to be dealing with a board of directors. You probably will have business advisors. And if it's a technical, a medical device company or a fintech company, you probably have scientific advisors as well. So this is your world as the entrepreneur. So just some basics here. When I teach this course, my students have to form groups, ideate, come up with a good idea, and write a business plan. And the whole purpose of a plan is basically to organize your thoughts and think thoroughly through every part of your development of the business. Really, all it is a roadmap with directions and timelines. And roadmaps, of course, never survive reality. But really, the primary purpose is if you have to raise money, you have to convince somebody you know what you're doing. And a business plan is nothing more than a bunch of little plans related to various aspects of the business. You have a front part of it. You have the main event, and you may have some appendices and other kinds of things. But clearly, the main part is to talk about the problem you're solving. What is your solution? Maybe it's a technology solution. What's the market about? How is it going to be receptive? And how are you going to address all this? What capabilities do you need? You need manufacturing. You need a financial plan. And at the end, the exit is really how investors are going to get their money back. So making a plan compelling is really important. And the first thing you need to know is that people don't read. Okay. The people you send it to. This is how they read a plan. They go first to the executive summary. Look at that. Okay, that's pretty interesting. If they like the idea, then they go to the financial section. Well, how much money are these folks going to make? And if they like that, they'll go and see who is on the management team. And that takes about 5 minutes. If you're in a venture capital firm, you might, and you're reviewing plans, you might review 200 of these a week. So that's a lot of work. So do you have any interest after these things happen? If the answer is no, there's a special storage place for that plan. If the answer is yes, then they go back and read everything else. So a very important part of that plan is your business model and also your financial plan. A lot of people get these two things confused, and I want to just define them for you. What's a business model? Well, it's whatever strategies and tactics your business intends to use to ensure that, at least at some point in the future, you're going to have a profit. Your revenues are greater than your expenses. Remember the magic equation. Apple is a great example. 30 years ago or so, or 50 years ago, whenever they started, why would people buy an Apple computer? Well, mostly because it had a nice design. It was very functional. It was very easy to use compared to the competitors of the day. So that was their business model, right? Let's make a nice looking piece of equipment that's really easy to use. However, there are other business models. You may be aware of Dell Computer. Dell is a very large computer manufacturer, and now you can buy them in a store. But their business model, Michael Dell's business model, was totally different than Apple. His business model was you couldn't go buy it in a store. So what you had to do was go on a website and order it. But in doing the ordering, you had to tell all kinds of information about what you really wanted. How big was the hard drive? How much memory? What kind of operating system? And they would make it for you to your specifications. So their business model was very different. We'll build to order, and we don't have to have a warehouse somewhere full of computers, whereas Apple had to guess what people wanted and then make them ahead of time. We would all be happy to have the money of the founders of Apple or Michael Dell. Good business model, lots of money. So since the business model describes the rationale of how you're going to create, deliver, and harvest value, the financial plan is the numbers part of that. That's the estimate of how revenues, costs, and profits are going to be generated by the new venture. Okay, now financial planning is really important from a goal setting point. You can go to the literature, and there's all kinds of reasons that people will tell you success is very much related in goal setting to the planning process. If you have a plan, you're working smarter. If you have a plan, it is always of the future, and so you've got to be oriented in that respect. You need to, as you're going along, compare what you plan to do to what you are doing. Maybe you need to update something. May clarify your personal motivations. It's obviously part of a financial plan is numeric, so you've got to worry about results. And it helps you manage risks. And this is all well and good. You can go to any textbook and they talk about this. But there's one reason which I like, which is the most important reason, and it's not in any textbook. And you probably don't know who this gentleman is at the bottom. He's a famous baseball player from the New York Yankees in the United States. He's He did his career 50 years ago. He's very famous. His name was Yogi Berra. And he said, if you don't know where you are going, you are certain to end up somewhere else. He actually became a philosopher, believe it or not, on the order of a fellow like Mahatma Gandhi. So that's why you do business planning and financial planning. Okay, so why do you develop a financial plan? Well, you're going to be employing resources. You need to allocate them, people, things. You need to control your growth and spending by comparing what's happening to what you planned would happen. And you need to understand how much money you need to raise to cover your expenses until your venture becomes profitable. Now, when you go into textbooks and all, they talk about financial planning. They talk about the three main plans, something called a profit and loss statement, something called a balance sheet, and something called a cash flow. We're going to talk about two of these, but with specific respect to what's important about them for an entrepreneur. First, the P&L. Here's an interesting thing about accounting and finance is that there are lots of different terms that mean the same thing. I'm a physicist by training, and in physics, if you E equals mc squared, we know what C is, we know what M is, and we know what E is, and we know how they're defined. But in accounting, it's different. So there's different names. The step, if you're going to create a P&L, a profit and loss statement, or a statement of operations, the first thing you have to do is create a revenue forecast, okay? And then you've got to figure out what all of your costs are going to be. How much is the cost to make the item that you are selling, cost of goods sold? What are your marketing and sales costs and other kinds of costs? And then you can just create the P&L using a spreadsheet format. But I want to focus on something which is really important for the entrepreneur and rarely understood well, and even more rarely forecast well, even by experienced salespeople. And there's a idea here that whatever revenue you bring in, you have a price for your products and you have a number of products that you sell, okay? And sales price is often kind of dictated by your salespeople, and how many people buy are heavily influenced by how good your marketing program is. So why you to develop the revenue model? Well, you need to understand your markets and any sub-markets. And of all the markets that are out there, which are the ones you want to go for first? Your target markets. And you need to understand your customers. And the revenue model forces you to quantitate these markets and how you're going to penetrate them. And it starts with the revenue model. This is how it's really done. You have to, sometimes you're in a complex situation. There are three principles that I talk to students about. You may have a complex situation. And how do you simplify it? For example, if your idea is a communication app, suppose you're starting a new restaurant. You sell all kinds of foods and drinks in that restaurant, maybe dozens of different kinds of things. How do you project revenue there? Suppose you're selling product by different weights, maybe fertilizers or something like that, 1 kilogram, 5 kilogram, 20 kilogram. How do you handle managing a worldwide introduction? Well, if you're selling communications app, it's probably pretty easy. How many people you think your revenue is going to be, how many customers you have, and maybe there's different revenue streams, but it's really easy to figure out how many customers you're going to have or project. Maybe if you got a restaurant, you don't say, I'm going to sell so much Coca-Cola, so much beef, or so much. Maybe the average person who comes into your restaurant spends $10. So there you go, an average spend by a client. That's reducing complexity. Suppose you got multiple product weights with different prices, maybe an average price per kilogram. Worldwide introduction, pretty simple. Start with some place you're going to first and add as appropriate over time. One of my companies I'm working with is in Nairobi, Kenya, and they're launching in Kenya. It's a POS system, but they're going to be moving to Ghana, Zimbabwe, Nigeria, and they've got a plan for the first 12 African nations they're going to go to beyond Kenya. Next thing is quantitatively defining your market, and this is really not well understood. Who is your target market? Who are you first going after? where are they, and how many are there? And I want to give an example of that from one of my student teams from last year in Virginia. Their idea was pretty simple. It was they were US students, so the idea was geographically situated in the US, and a lot of people, as you may know, own big lawns in front and back of their houses in the US. And their idea was a robotic lawnmower to actually, you don't have to go out and mow the lawn yourself. You just turn it on and it goes and finds your lawn and mows it. Okay, so here's what they said. When they came to me with a marketing plan or a revenue plan, they said, well, the lawn care market is worth $64 billion in the US. And they said, that's our market. Well, I don't know what you're thinking right now, but lawn care is a lot of things. Lawn care is a generic term. It means lawnmowers, but it means pesticides, fertilizers, services, and tools. So can you, obviously you don't have, if you're selling lawnmowers, you don't have access to the client who wants to buy a fertilizer. So they came back and said, okay, well, they did some more AI work and they came up with a notion that the lawnmower market in the US is about 12 billion in 2025. Well, that's a sizable market. Okay, that's a good start. But it really didn't serve them well. Let me tell you why. There is a better way to think about it and get better accuracy and size for an estimate for a market. In the US, there are about 55 million lawns. These are not lawns from a big building, say, or from the White House or something, but they're lawns of people who own homes and want to cut their lawn, okay? There's 55 million of those. There are robotic lawnmowers in the market, and they range in price from $1,500 to $2,500 each. And there were some more expensive ones, but not many people bought the more expensive ones. So if you figure the average mower costs $2,000, you can calculate the total potential or total available market is the multiplication of those two numbers, and that's a big number, $110 billion. When you're talking to an investor and you're saying, we're in a great market, you can tell them 12 billion or you can tell them 110 billion. If you can tell them 110, you're in better shape. So quantitatively defining your market in a reasonable way and believable way is really important. The third thing is, how much of that market are you going to take? 1%, 2%, 0.5% over time? And how often do people buy something of your service? If you buy a lawnmower, it happens once, obviously. But if you come into a restaurant, maybe they come in 3 times a month to your restaurant, your average customer. I don't know. So how many units do they purchase every time they come in? And how often? Every month, every quarter, every 5 years, okay? That's it. And normally I would show my students a spreadsheet example where I have a model for multiple products. And I don't have time to show that today, but it's a very simple process, but it starts with understanding your market. So beyond that, we talked about developing a financial plan is allocating resources, controlling, raising seed capital. Well, once you have your revenue statement, you have to go right to your profit and loss statement. That's a really important document. And you have to start by creating your revenue forecast, which we just talked about. You have to figure out whatever costs you're going to have, as we talked about a moment ago, and you just create the P&L in a spreadsheet. And the elements of a profit and loss are really simple. All your revenues from whatever you're selling, all your expenses related to making the things you're selling. Maybe there's labor, maybe there's materials, you do it yourself. Maybe you contract it out, makes it simple. Then there's all kinds of operating expenses and other kinds of things as well. And they all go together. And the reason 2 of these are in red, depreciation, amortization, these are specific to a profit and loss statement. And I'm going to talk about that in a moment. But it's a layout. You got revenues at the top, and you've got cost of goods sold and other kinds of expenses. And it's an easy thing to lay out for some period. Maybe it's a quarter, maybe it's a year. Just to know, again, to my earlier point on terminology, quite often revenues are referred to as sales, cost of goods sold, COGS are referred to as direct expenses. All your other expenses might be operating expenses or indirect expenses or overhead. There's different names for these. But the important thing is if you subtract your direct expenses from your sales or COGS from revenues, you get a number. In this case, $100, and maybe cost of goods was 40 for that period. So your gross profit is the two subtracted, leading to a margin, which is a percent. And this is, people often use the word margin and they use dollar or whatever is the currency in the particular country, shillings in Kenya. Then you have your operating expenses, and when you subtract those out, you have something called an indirect profit or an operating profit. You have a margin, and then maybe you have taxes and some other things, and you end up with a net margin. The reason I show you this as a layout, it's very simple, very straightforward, and these are margins that kind of are pretty decent margins. 60 for if you're a manufacturing company, to have say an automobile company, to have gross margins of 60% is pretty good. To have operating margins 16% or net margins 10% is pretty good. Very different in different industries. Pharmaceuticals are very different than phone apps. Okay, but what's important, another important thing is if you kind of remove that, move some of the items down below, you have something, and do the calculations, something called earnings before interest, taxes, depreciation, amortization. That's referred to as EBITDA. That's a way that investors actually calculate the value of your company at some future point in time. And I won't go, but if you're the CEO, man, you're worried about your gross profit and you're worried about your net profit every day. Okay, I'm not going to talk about a balance sheet. It's not as relevant to entrepreneurs. It's an important document, but the P&L is, I call it the second most important document. The most important document is your cash flow statement. And why is that? Cash is king. You run out of cash, you're out of business. So the whole purpose of a cash flow projection is to help you manage cash, and it reflects the cash status of the business at a given point in time. The important reason, though, that you generate such a document is to understand how much money you're going to need to raise to become profitable. Let me give an example. Here's a statement of a cash flow, looks very much like a P&L. You've got cash coming in. Well, in this case, this is an example over some period of time, over maybe these are months, maybe these are years. But at some point, you're getting started as a company. And at some point later on, you're going to have some sales in thousands of dollars, say. Okay, so that's, you can get money from other sources, but revenue is what you're starting with first. Then you assemble all of your expenses, just like we talked about before, from the P&L. You know, how much labor do you have? Direct labor and fringe is stuff related to manufacturing. So apparently you're not hiring those people and paying them and starting to manufacture until period 3. And there's all kinds of things that go there. But the important thing is you can sum these and get how much cash you need for each period. And then to complete the table, you ask the question, what am I starting with? 0. How much, what's my change? In this case, negative 15,500. And my ending cash position is negative. It's red. Not good. So you say, okay, well, now I think I know kind of my cash situation. What am I going to do to correct this? Well, let me sell some stock in my company. Okay, I've got some friends and maybe family who will buy some stock in my company, and they'll pay me $100,000. And I put that in, and this is a spreadsheet. So you immediately can recalculate, and lo and behold, it looks like for the first 2 periods, you're pretty good, but you go slightly negative and go even more greatly negative in period 4. So you say, okay, well, I don't think I can sell anything any more stocks to my friends and family, but maybe I'll take out a bank loan. I have some assets by period 3. So let me take out a bank loan for $45,000. And I'm in the spreadsheet, and look at that. Voila. I've got positive cash flow all along. So I know now that for me to create a profitable enterprise, I'm going to need to somehow obtain $145,000, más o menos. Now, there is something wrong here, kind of a learning point, is that one thing you have to do, if you do something up here in the income or cash inflow, sometimes it affects what you do down there. If you take out a loan with a bank, you're going to have to pay that loan back. And so you got to make sure you account for that as a payback. And in this case, it's just $1,000 per period, and it really doesn't affect your overall cash flow. So the rule is for cash flow, you can't operate any business with a negative cash ending balance for any period. And so this I call the most important document for a financial document for an entrepreneur, and it has to be believable. Now, when I talk about entrepreneurship, we talk about opportunity and innovation and commitment and organization and risk. Risk is often in the hands of those who are giving you the money, okay? And so where does money come from? Well, there's, as you may know, probably do know, there's a lot of different places where money can come from, but how do you raise it? You're going to need it to start your company. Unless you're independently wealthy, or maybe you're a sheikh from Saudi Arabia, or maybe you know very well the king of Morocco. Unless you are in one of these categories here, you're going to have to raise capital, some money to launch, grow, and sustain your business. And so there are lots of places you can get capital from. And I just put a list here, and I want to talk about these very briefly. The top, your own savings, maybe grants if you're a university, or you can obtain small business grants, or maybe private investors. We just talked about that. Or maybe angel investors who are rich people who have an interest in your particular idea, or maybe crowdfunding. Those are all for entrepreneurs who are just starting companies. Spending some of your own money is good. Investors like to see that you've got some of your skin in the game. Grants are great if you can get them because they don't involve ownership. So they're non-dilutive to your ownership. If you've got private and friends and family, it could be disruptive if you don't do well. You hate to tell your brother you've just lost a lot of his money. Angel investors are pretty easy money, and I'm not going to talk about them in great detail, except to say that that's a lot of startup money comes from angel groups. And crowdfunding, it's being used. It's hard to tell how that's happening, what's happening really. Other forms of capital, it's tough. You need to be well along to get venture capital. Banks won't loan you money unless you have assets. In other words, things that you can secure your loan with. Strategic partnerships with, say, another company that's interested in your idea, you require milestones. Trade credit and a public sale of stock are usually associated with more mature companies that are closer to an exit. So here is the challenge in convincing somebody to be interested in you. Looking at it from the investor's point of view, there's not a lot of data about particularly if it's a very innovative idea. There's a lot of qualitative elements, a lot of uncertainty, and there's a basic conflict between you, the entrepreneur, and your potential investors. You got the idea. You're enamored. You are delighted. You think you're worth a lot of money. The guy with the money, or the gal with the money, has a very different thought. They are going to try to, if they may love you, idea, they may think that you're going to be very successful, but their incentive is to own more of your company for less money. So you have a basic conflict there, okay? How do you cope with it? Well, this is the way early stage investors think. And there are methods of coping which are detailed in part of the course that I teach, but I'm not going to go through them today. But think like an investor. Investing companies invest. Some companies I've worked with have invested in maybe 1,000 different investments a year. Okay, so this is the way they think. For each 10 companies in which they invest, about half will fail. Maybe 3 or 4 will when they can sell their stock. Will maybe return a small amount, maybe the same amount you gave them, or maybe 2 or 3 times what you gave them, but 1 or 2 will be big ones. I have a very good friend who, but let me just, if this happens, the investor receives a total return on all their investments of maybe 25% a year or more. I have a very good friend who is a fellow in Houston. He founded an outfit called Vanguard Ventures. And one of their first investments was a small company nobody ever heard of called Adobe. I'm sure you've all heard of Adobe. He put $1 million into Adobe very early on. And when Adobe had an exit, he got back $480 million. He had a return of 480 times. That made him for his entire life. So whatever approach you use as an investor needs to be a logical framework to guide this process and provide a logical means for guessing the probability. And my last real statement here for this talk is there are probably as many methods for doing this as there are investors. Okay, and I would finish with a quote. I like quotes. John Kenneth Galbraith, a very famous economist, said, "The only function of economic forecasting is to make astrology look respectable." This is hard to do. But my friend who did Vanguard Ventures, he is retired now. He's a billionaire. He ran Vanguard for 34 years. And over that time, he returned to his investors, because he raised a fund and he invested in many companies like Adobe. He returned an average of 50% a year on his investors' funds over a 34-year period. He would have made a really good astrologer. So the devil is in the detail, and the detail is in your assumptions. And we've talked a little bit about that today. So I want to thank you. I know I'm finished a little bit early, but I wanted to make sure it was a lot of data, a lot of information here. I thank you for your attention. This is my advertisement for where I live. I live south of Guadalajara, Mexico, on a lake you can see there called Lake Chapala. And that mountain on the other side of the lake is almost 8,000 feet, maybe 2,700 meters in altitude. And that's a typical day in Chapala. It's a very nice place. So come to Mexico and visit. We'd love to have you. And if there are any questions, I'm happy to address them.
Thank you, Dr. Price, for this valuable talk. We will now move to the Q&A session. Please feel free to ask your questions. I see that we already have some questions here.
Great.
We have one from Zainab, who asks, how do you choose the right business model for a startup in its early stage?
Well, usually investors, if you're looking to invest, you usually have maybe the best idea for you is to have some knowledge, intimate knowledge of what kind of investments you are interested in. For example, I talked about angel investors, right? And they're very common. That's a very great way. Let's say you have a new medical device, and I work with a number of new medical device companies. When you go in front of angels, typically it might be a group of 15 or 20 people, very wealthy, who are all medical doctors, and they have determined that they have a lot of money, they want to spend it, and they want to invest in projects or products or ideas that make a difference. So they will have knowledge, right? They will quite typically have knowledge about that and will be in a good position to determine whether the business model is a good business model. Okay. And so, and if you're an investment firm, and one of the things we didn't talk about is how investment venture capitalists operate, is that there's many attitudes they have. One is they have what is called a sweet spot. And a sweet spot would be, what is the amount of money they like to normally invest? If you're looking for $500,000 for your company, you don't go to JP Morgan because they don't touch anything under 100 million. If you're looking for 500,000, you go to a mid-stage or early investors. And the sweet spot not only is the amount of money, it is the it's called portfolio remit. What are they interested in? If you're going to a venture firm and you've got a new fintech point of sale system like this Nairobi company, you don't go to a medical device investor. So the people who are investing will have knowledge. They will have advisors, and I do this advising for many, and they will who will be able to technically advise the investors as to whether the business model is suitable from their knowledge of the markets, the competitors, and the potential clients. Okay, so that's how do you know if you're my direct answer. If you don't know, if you're an investor and you want to invest in a particular company and you don't know much about the market or the competition, or you're not in a position to determine whether the idea is a good one or not, I would say either get someone to help you or don't invest. Go somewhere where you have some knowledge. Okay, sorry for the long answer, but it was a good question, but a complicated answer.
We have another question from Hanan, who is asking how often should the business model and financial plan be updated?
How I didn't hear how essential?
How often should the business model and financial plan be updated? How often should it be updated?
Oh, to be updated, you mean?
Yeah.
Well, obviously you go to investors and let's say you're going to show them a profit and loss statement. People like to see that. Quite often, and I don't have examples right here to show you, but as you start the business, okay, let's say you've raised your money, you've projected out 5 years, and maybe it's going to take you a couple of years to be profitable. You are watching progress, your expenses, and how you're spending money probably every week. You watch that like a hawk, as we say. And I don't know that if you're a good, accurate predictor about product development times and expenses involved, say, in developing your product, you won't have to update it too often. But unanticipated things happen. New competitors show up. We don't have any oil. The oil gets stopped, and gas costs more, and everything costs more. You should be, as the CEO or the entrepreneur, should be updating all the time on a weekly basis. But as to how you communicate that to your investors, unless you have an event, usually a terrible event that happens, then you usually communicate to investors on a quarterly basis. You give them an update, and hopefully everything is on time and on budget. And that's quite often the case, but no more than on a quarterly basis. Quite typically, as an entrepreneur, if you have some significant investors, they will become a part of your board. That's part of the deal, right? And so they can watch their investment, and you meet, if you have a board, you probably meet once a month or maybe once every 2 or 3 months. And so you just keep them apprised. The only thing you don't want to do is have something happen bad and you don't tell them about it. That's the worst thing you can do. If it's really good, you'll tell them immediately. So I hope that answers the question.
Thank you. There's another question who says, how can entrepreneurs make their financial plans more? I think we already do this. No. How can entrepreneurs make their financial plans more attractive to investors?
Okay, well, many ways. First of all, how long will it take you to become profitable? Okay, so and in a believable way. Okay, so that's a very important thing. In other words, if you are, and I've been an investor in medical device companies and biopharmaceutical drug companies. I know because I've been in that business, it's going to take a number of years for the company to start making money because they have a unique idea maybe, but then they have to develop it, test it in clinical trials, and then get regulatory approval, and that's a horrible process. So you have to sort of be if you can somehow short that, make that process shorter because of your unique idea in that field, that's a desirable trait, right? One of the reasons people invest in medical devices and biopharmaceutical drugs because they're very profitable once they start making money. Okay, maybe you're not interested in that. Maybe you're interested in investing in phone apps. Then you probably want to be investing in a company that's going to be profitable within a year. They don't have to go through regulatory. They've got such a great idea, they're going to swamp the competition. So time to profitability and amount of profitability. In other words, if you can show them a plan that shows your net profits are in the tens of millions of dollars in a short period of time with high profit margins, that's pretty good. The other part, the kind of a sequel part to that is, are you doing it without making an unbelievable claim on how you're going to take the market? For example, that lawnmower example I gave, right? Now, obviously, with a $200 billion market or whatever the number was, you're not going to take all of it. If your financials that you show to investors say that you got to take 50% of a market to become profitable, as we say, you're toast. You're not going to make it. If you can be profitable with taking a small amount of the market, in other words, look at this market. My God, here's a $200 billion market. We are going to take ultimately 5% of that market. Well, that's $10 billion in revenue. 5%? I'm an investor. I believe you can take 5%. I think you're better than your competitors and so forth and so on. So if if whatever your financial projections are, if they are more believable, if you don't have to own the market to become financially successful. So there's a lot of things they look at. And obviously they'll look at your competition and look at pricing and all of this kind of thing. So it's again a complex answer, but in short, having good profitability in a short period of time without having to dominate a market are all good things.
What are the most common mistakes entrepreneurs make in financial planning?
In financial planning, okay.
Yeah.
Well, in financial planning, the number one mistake, I mean, there is a list of why companies fail. And I'm going to use the US as an example because it has arguably one of the best entrepreneurial ecosystems in the world. And in the United States, of all new entrepreneurial startups in a given year, 50% of them are dead within 2 years. 80% of them are dead within 5 years. And 98% are dead within 10 years. And what are the reasons that they fall off the cliff? Well, the number one reason is not a sales and planning thing. It is they didn't understand the market. They built something, but the market didn't like it. The number two reason for failure is they underestimate the cost of developing their product and underestimate the time it takes to get the product to market. Okay. So cost is the number two. They run out of money. That's what that means. They run out of money. It's probably the biggest problem that entrepreneurs have. And it's the second largest reason in the US anyway, why entrepreneurial ventures fail. Something happens. They didn't plan on this competitor, or my goodness, they couldn't get this particular chip from China or something. And there's all kinds of reasons why they have to spend more to get where they need to be, and they run out of money, and that's it. They find trouble raising more money. So it's having an ability and an experience, which is why they look at management. Man, if you're Bill Gates and you're starting a company, they're going to react very favorably because you've started companies and you've done quite well. You've managed those risks, but underestimating cost and underestimating time to market are two big ones.
Okay, thank you. I think this is all the questions.
Okay, great.
Okay. Once again, thank you, Dr. Brandon Price, for sharing your expertise with us today. This session was very enriching and informative. And thank you to everyone who participated. Maybe you want to say something, Dr. Price?
Well, no, I was just going to say, if anyone wants to contact me, I put down here my email. It's my one at Virginia Commonwealth University. Please reach out. I'm very open to answering questions. I'm not a consultant who charges money every time he answers a question. I want to help entrepreneurs, and that's what I do. So let me know if you have questions or something in particular that wasn't answered or addressed in this particular session. I'd be happy to do it. So please don't be afraid.
Thank you. Thank you to everyone who participated and contributed to the discussion. We truly appreciate your presence and hope to see you in our upcoming session. Thank you.
You bet. Take care. Thanks a lot. Bye-bye.